Let's get into the mind of Vincent Deluard, always a curious adventure, the global macro strategist at StoneX Group. Vincent, good afternoon. Good to be here. Let's kind of get your first take on what you think we should expect from Powell tomorrow. I know that you don't purport to be a mind reader, but this is the big story next, okay? What's kind of your framework going into the next 48 hours?
Well, I think, we'll see more of the same, a lot of talk. I think the Fed hopes in the power of the magical word, and so far it's worked fairly well. I mean, the Fed hasn't had to do much. I mean, just by hinting at possibly doing something in the future was enough to get the outcome that they expected. So I think as far as the markets go, the Fed still has a lot of credibility and a lot of power. Now, the problem, of course, is that power does not extend to the economy. I mean, the Fed cannot print workers, it cannot print commodities, it cannot print chips. So this narrative that we're in right now, where the Fed tells the market, it's all good, inflation is transitory, it's base effect, don't worry about it, we have the tools to fight it if we wanted to fight it, but we don't want to do it right now. That works as long as inflation doesn't persist for, what I would say more than a couple of months. So I think the next meeting is still going to be okay. The problem, I think, is going to hit in the fall. And by the end of the year, if we remain at this 5% plus, it's going to be very hard to blame it on base effect and other transitory effects.
Vincent, as you mentioned here in your notes, Delta variant, lack of new stimulus story playing a role in that soft patch for the reflation trade that's happened. But how much else has been coming from that shift, though, in some of the language? Powell may not be a hawk, but at least he is giving some respect to others in the group and giving a little bit of a different tone last time around. Is that what is is this market kind of front running, tapering a little bit when it's been buying bonds and freaking out a little?
Yeah, it's been surprising to me. I mean, if I look at what actually happened in the last meeting, I would say very little, right? I mean, it's two dots on a dot plot that historically has no significance to the path of future rates. I mean, it's been wrong many times before. And even the change in tone, I thought was, very, very moderate. But the market reacted very, very well in the direction the Fed wanted it to. And I think to me, it's a psychological thing. The thought of reflation is very painful for the market. If we do have, as I expect, and I expect it for a long time, a shift towards secular inflation, everything that we used to rely upon as investment manager, the negative correlation between stocks and bond, the Fed put, the constant expansion of multiple, the basically steady 7 to 10% return for a 60-40 portfolio, all that is in jeopardy. So I think subconsciously investors feel that, and they fear that. They don't want that to happen, so they cling to whatever data point or promise that the Fed gives them that it's not going to happen. And this summer they got some of that, right? We had a couple of somewhat disappointing economic reports. And then on top of that, they chose to focus on the one or two sentences in the FOMC meeting that suggested that the Fed would not let go of inflation as people had feared before. So in a way, it's people wanting to believe what is comfortable for them.
Now, Vincent, looking at how this has played out, one of the other things that you pointed out in your recent analysis is that some of the major turning points for the yield coincided with the pattern of buying and selling with some of the big bond funds, right? One in particular. Remind us what that is, because you've given us some of this analysis before, but you're basically looking at kind of defined flows, or what?
Correct. So I'm looking at target date funds. I think really it's one of the most misunderstood and yet most powerful forces in the market in the way they rebalance. I mean, I think a couple of months back you had me about the equity market, and I was observing that 4 times in a row the stock market had bottomed on the same day, basically the last Friday of the quarter. I'm like, what are the odds of that happening, right? And we saw the same thing with bond yields. The actual top, I think, on the 10-year yield was on March 31st, the last day of the first quarter. And that makes sense, because if you are a target date fund, you have to maintain a fixed allocation, based on the age of your investor base and yada yada, right? So every quarter you got to go back on target. So when you have a big a gap in the process and performance, like we had in Q1, right? I mean, equities just shot up and then bonds sold off. By the end, the last of the quarter, you get in panic mode. Oh, I got to get back on target, so you have to buy massively. And again, this is precisely the day when the 10-year yield made its cyclical top. So I would not read too much, honestly, in the fall in yields. And I think that's what the market has done. It's almost a snake eating its own tail. Yields are falling, that means inflation must be falling, and then because inflation must be falling, then that justifies more yield. Well, actually, there's a much simpler explanation. You had, I think, since November, stocks have outperformed bond by 40%. So if you are a target date fund, you have to, basically shift more than a third of your portfolio from stocks into bonds to get back on target. And again, the target date complex is massive. I mean, every American that has a 401k at this point is invested in some sort of a target date fund, which is very mechanical. I mean, that's why I look at the big Vanguard mutual funds. I call them the whales. There is a one for stocks. The one I was mentioning was the total bond market fund. Some of them have close to $1 trillion in assets. So these things can move the market. It's the tail wagging the dog instead of the dog wagging the tail.
So the really important part here is that there is, you attribute a good bit of the action to this, whether or not someone agrees with that. The bottom line is, even as long as it has some non-zero roll, it is price insensitive. It's basically inflation insensitive. It is in no way a reflection of the market saying, oh, future inflation is going to be low. And that's what's important here, because there's still a lot of connections being made where folks kind of innately see a lower yield as being reflective of lower inflation odds. So with that in mind, Vincent, one more question here as the market wraps up. We close down on the day, but the big takeaway for me today, Vincent, was that it kind of confirmed the framework that we've been using here, which is the yields have been going lower as the Fed has been responding more to inflation. Even if it's transitory, it's not transitory enough for them to not act. So as they've gotten more hawkish, yields have gone down. Then what do you look for to see what can release yields higher? Is it if Powell comes back, doubles down on average inflation targeting, or yields going to rocket back up?
Yeah, excellent question. I don't want to get too much into trying to second guess the Fed, because to me it's kind of a losing proposition. I would focus on two things. One is this target date fund dynamic, and this is a very I'm going to use transitory again. The reason we had so much buying of bond funds is because stocks did so well, right? So the weight of stocks in fixed allocation portfolios increased, so that created buying demand for bond funds.
So stocks go down.
Right. As soon as the stock market rally stops or slows down, that demand is going to wane. So that would be one thing that we'll be looking for yields. Second thing that we'll be looking at is flows from institutional investors in Europe and Japan. I mean, one thing that happened earlier this year as the U.S. yield curve steepened is that it made the cost of hedging a position in U.S. Treasuries very cheap. So basically what was happening, if you were a German insurer, instead of buying a 10-year bond that minus 90 basis point, you could buy U.S. Treasury, get close to 2%, and your hedging cost was less than 1%. So net, you had a positive 1% yield, which again, in the world of financially repressed Europeans, it's positively amazing. So I think that created some flow from insurance and pension funds in Japan and in Germany into the U.S. Treasury market. And if you think about through covered interest rate parity, the driver of that is the difference in the slope in the yield curve between these regions. And what we've seen, obviously, in the past 2 months in the U.S. is massive flattening of the curve in the U.S. And while the curve is actually steepening a little bit in Europe as people start to think that the Fed, start to thinking about raising rates. So that incentive, the hedge is gonna increase again, and the attraction of the U.S. Treasury market for foreign flow is going to diminish. So I think that will be another driver for yields to go back up, regardless of what Powell says.
Okay, really like to take Vincent. Always a unique perspective, as I always say, but it's true. Thank you, sir, for the insight here on what you're looking for a different approach thinking about bonds and the flows behind that. But bottom line is correlation between stocks and bonds seems to be something that can be here to stay through that lens of the target date fund. Vincent, good stuff.